Let's stay on the market. Let's bring in Ariel Investments Vice Chairman Charlie Babrinskoy and HSBC Chief Investment Officer Jose Rasco. Great to have you both here. Charlie, I'm going to kick this off with you. I'm going to pick up on something that was just touched on by Mike and John, and that is what we've seen so far in this earnings season, because we've seen this upside surprise to earnings, but there's also been this debate with a number of Wall Street strategists writing about it this week on the concentration of those surprises being so heavy in tech and, to perhaps a lesser extent, financials. How do you see stocks coming out of this season?
Yeah, this is very important. The concentration in market cap is unprecedented, but those stocks are not contributing a record amount of S&P earnings. They are trading at huge multiples and are not contributing the earnings that their market weights would justify. So there is a lot of evidence, if you look back at times in which there's been this kind of concentration, owning the rest of the market has been the right place to go. I always like to point to people in 1999, Microsoft was a wonderful company trading at 35 times earnings. Over the next 10 years, earnings tripled and the stock went down by 50%. Valuation eventually matters. I know I've said this for a long time, but we're starting to see some cracks. We had a much better month. The quarter to date was much better for small cap value. My fund, I haven't been talking much about performance because it hasn't been great relative to the market, but it outperformed the S&P by a lot this last quarter to date. So we're seeing some signs of change. Okay.
Jose, how do you see this market, especially as I know you're overweight U.S. equities? I mean, are we seeing a broadening out, and are earnings what's driving it?
Well, unfortunately, we've seen the opposite, right? Since the trough in April, Morgan, we've seen that the market has become more concentrated. The Mag 7 has driven a large part of the returns here. But what we see going forward is we see almost the quadrupling of earnings for the forgotten 493. And so to Charlie's point, I think you have to diversify. And more importantly, not just diversify because growth value is now 4x in terms of that multiple. That's unsustainable. And the Mag 7 versus the forgotten 493 in the last 3 months has been a 4x multiple as well. But more importantly is what we call diffusion, which is a lot of those technologies that have been driving the market are now going to filter through the market and begin to affect earnings in financials, in education, in hospitals, all across the board. That's going to drive earnings for the rest of the market. And we think that's what keeps the market rally going.
Charlie, I know we're still waiting for value here. You were just mentioning it. What's going to be the catalyst, you think, that shifts the market's mentality and attention back in the direction that you favor?
You know, it's always hard to predict, John, because, if it was easy what the catalyst was going to be, then the stocks wouldn't be as cheap as they are. I think one thing we can point to is some takeovers of smaller companies. There's so much private equity money sitting on the sidelines, so many big companies that have been waiting to do M&A to get more clarity from the Trump administration, and we're now getting that. So we had a name, ZimVie, which is a dental implant company that got taken over and was up 100% in 2 days. We're starting to see that kind of activity happening. The leveraged finance market is in very good shape. I think that could be a catalyst, some smaller value companies getting bought.
And Jose, part of your optimistic thesis is that productivity from tech is going to offset any inflationary pressures from tariffs. What kinds of productivity do you expect? How much is AI at this point factoring into that, or is it something else?
Well, AI plays a big role, definitely, John. And I think the key is it's not just productivity, it's the broadening out of that productivity. And you also have two other factors that we haven't mentioned. Number one is the tariffs we don't think are going to be as bad as what was announced on Liberation Day. That's an upside surprise to the markets from our perspective, because what was priced in on Liberation Day probably is not happening. And the second factor, which we think is accretive to earnings in the near term here, is the Fed. And when the Fed begins to move, we think it's going to happen in September, December, and March. When the Fed begins to move, that's also accretive to earnings. So we think there's upside surprise to earnings potentially here in the short term. But we have to get through this recalibration of growth value. And to Charlie's point, I think that's coming. But we're optimistic after that.